Hello, this is Julius from Basic Financials. I've had a request to do a video about mortgages. Now I'm not going to get into too much detail on what types of mortgages there are and which ones you should try and get. I'm not a mortgage advisor, I'm not an expert in any way on mortgages, so this is supposed to be just a basic idea of what mortgages are. So if you haven't yet bought a house, then this might be for you, just so you get a rough idea. Now, what is a mortgage? A mortgage is a loan, and it's a loan so that you can buy a house or a property. In this case, say a house. The reason it's called a mortgage is because the company or the bank, building society that lends you the money, they will take a charge or a mortgage, which is security. They will take it out over the property that you're going to buy. So what that means is that they will lend you the money, but on the basis that if you don't repay them the money for some reason, then they will get that asset. So they'll get your house if you don't repay them the mortgage. They will take your house instead. So that's what a mortgage is. Now, when you get a mortgage, you can't just go out and say, "Oh, I'm going to buy a house. I want a loan." You've got to have some sort of backing to show that you can repay that loan, which is important from all sides. You don't want to be going out and getting a mortgage that you can't afford to repay. It's just going to cause hassles. So you've got to be able to afford that mortgage. Now, in the past, and one of the reasons for the financial crisis in 2008 was a build-up of loans where it started in America, but it happened here as well, and you could see it happening as where mortgage brokers, because they tended to get some sort of commission for selling you a mortgage, and obviously banks and building societies, they made their money by lending you money. They were lent too easily if they didn't care whether you could afford to repay that mortgage or not, because they thought, well, property prices are going up. If you can't afford to repay the mortgage, we'll just take the property. Now, that's fine well, it isn't fine, it's horrible. But it's even worse when the property prices go down. You can get into a situation called negative equity. And that's where the mortgage, say you've taken out a mortgage of £200,000 to buy a £220,000 house, say. That seems okay. Property prices, they start to tumble, say, for some reason. You probably haven't seen it for a long time, but it has happened in the past. And say that property becomes worth £150,000, but you owe £200,000 on this property. That's not very good for anybody. You can't sell the property and repay the loan, and the bank can't do that either. They can't repossess your house with the mortgage that they possess and repay their loan, because it's the value of the properties isn't enough. So they might try and hold on, say, well, property prices will go up, but they probably will in the end. But that's what really was a big cause of the problems. So basically, what I'm saying there, got sidetracked a bit, but it's important that if you take out the loan, that you've got every expectation that you can afford to repay that loan, and you should also factor in the fact that interest rates at the moment on the loan are very low, and they may well go up in the future. So really you need to try and factor in some sort of safeguard for that. Now, you would hope that if you're in a job, a fairly secured job, you're starting out, and you might hope that your wages will go up as you progress and get more experience, and then that would hopefully cover any increase in the mortgage. But that's what a mortgage is. So basically, you're taking out a loan so that you can buy a property. On the whole, I would try and say that you don't want to be getting certain loans, like credit card loans. You don't want to be doing. There are certain loans that you have to do, or are a good idea. For example, if you haven't got enough money to buy a car, but that car will enable you to go to a job where you can earn money, then it would be a good idea to take out a loan to enable you to earn that money. Now, a house is another one of those situations where it can actually be cheaper to buy a house than with a mortgage than it is actually to rent a house, which seems crazy, but that's the way it is. Rents can be huge, and if you're paying that each month, and you end up with nothing, you haven't got a house, you don't own a house at the end of paying the rent. Whereas if you get a loan out and actually you're paying less a month on the mortgage than you would be in rent, and after the term of the mortgage you actually own the house, then, well, that's got to be the better thing to do, hasn't it? Now, why doesn't everyone do that? Partly from what I was saying at the beginning, a lot of people can't get a loan, maybe because they haven't got enough. They haven't been in a job long enough to show that they can afford to repay that loan. Maybe they're self-employed, which that doesn't mean you can't get a loan, but you have to have often 3 years worth of results and fairly good results and improving results to show that you can afford to repay the loan. Also, most times you'll need a deposit. Yeah, there aren't a lot of lenders that will lend you 100% of the value of the property, and they would expect at least 10% deposit, and it can take a while to save that up. So those are reasons why some people will be renting as opposed to buying, which it all seems a little bit skew-whiffed, doesn't it? If you can't afford to rent, but renting is more expensive than buying, things aren't quite right, aren't they? And I would say things do feel like that out in the property market. Things don't seem right, but house prices seem to be endlessly going up. It's a bit steady at the moment. We're in early part of 2019. Things have been a bit more stable, but property prices going up isn't really something we should be wanting. If you're buying a home, then it's your home, and I mean, my thought is that if people go out buying second, third, fourth, fifth homes so that they can rent out to people, it's just driving a problem of increasing house prices and stopping people being able to buy at what at the moment is a lower rate. Now, don't forget that lower rate at the moment is because interest rates are low, historically low, and have been for quite a long time. Now, if they did go up, we would have quite a problem. If interest rates go up by more than 1%, that's going to cause quite an issue. And there are an awful lot of people out there with mortgages of more than £200,000, and that's 1% interest. It's quite a lot of money each year, and it could cause some big. I mean, if they do go up, it could even go up by more than 1%. It could go 2%, 3%, and that's going to cause some real issues. That's when house prices would start to take a hit. Be lots of repossessions. Has happened in the past. I don't really think anyone wants that to be happening. The government certainly don't, which is why they've been doing things like pumping extra money into the economy. That's a whole nother subject. But anyway, that's what a mortgage is. Gone a little bit sideways on that, but hope you found it interesting and helpful. It's just a basic idea. Not trying to get into all the details of the types of mortgages. There's lots of information on internet sites. MoneySavingExpert.com. I always think that was a good one for looking at types of mortgages and the types of deals you can get, and the different schemes as well. There are lots of different schemes to help people to try and get onto the property ladder. Thank you for listening. Like and subscribe as usual. If you've got any comments or anything you want me to do a video on, just make a note, and I'll see you again soon.